Why bankruptcy and foreclosure affects your credit score less than you think. Brought to you by CreditSecretsBible.com. Bankruptcy filings are on the rise. In the first half of this year, bankruptcy filings in the U.S. rose 48% over the same period for the previous year, with over 391,000 households with consumer debt filing for bankruptcy. That's according to the American Bankruptcy Institute. Samuel J. Giordano, the executive director of the American Bankruptcy Institute, reported that, quote, "The new uptrend in bankruptcies reflects the economic reality of households under increasing financial stress. We expect bankruptcy filings to continue to rise for the balance of the year." The foreclosure epidemic. The subprime mortgage meltdown and the resulting spike in foreclosures have contributed to some consumers' need to file bankruptcy. In October, 224,000 foreclosures were filed nationwide, and that's up 94% from the previous October, according to RealtyTrack. According to Darren Blomquist, a spokesman for RealtyTrack, foreclosures could hit homeowners even harder in the year ahead. As the interest rates on many adjustable-rate mortgages reset, mortgage payments could rise beyond some borrowers' ability to pay. Blomquist said the other side of the vice pressing on these people is that it's harder to refinance because lenders' standards are tighter. The drastic change in the housing market has even caught some real estate professionals off guard. A couple years ago, Rob Rosen, a real estate agent in Las Vegas, bought 16 homes at the height of the boom. He'd hoped that the appreciation in his investment properties would provide a comfortable retirement. When he was no longer able to keep up with the monthly mortgage payments that totaled over $45,000, he stopped making payments. The lenders foreclosed on all of his investment properties, which he says caused his credit score to drop from 730 to the high 400s. Now, Mr. Rosen said he's considering filing bankruptcy. He said he had no other option but to walk away from his investment properties. Quote, "You get to a point where your hands are tied." Credit can be restored after bankruptcy. If you've got financial troubles, it's cold comfort to know that you're not alone. But there is some good news. You can rebuild a good credit rating after bankruptcy, and it can be faster than you might expect. Anita Burleson filed for bankruptcy a couple years ago and has had difficulty reestablishing credit. But she knows that some other debtors have successfully borrowed after their bankruptcies. Quote, "When I was in bankruptcy court, there was a couple that had filed for bankruptcy twice prior to this one," Burleson said. "How could they get enough credit to get them into this much debt 3 times? Just about anybody can get credit soon after a bankruptcy if they know how." What effect does bankruptcy have on your credit rating? Of course, filing a bankruptcy has a negative effect on your credit rating. A Chapter 7 bankruptcy can stay on your credit report for 10 years, as can a Chapter 13 filing, although 7 years is typical. Plus, debts that are discharged through bankruptcy are not automatically removed from your credit report, and they may continue to show as derogatory items unless steps are taken to clean up your credit report. Lenders are primarily interested in the last 12 to 24 months of a borrower's credit history. The challenge for the post-bankruptcy borrower is to convince lenders that he or she has turned a new leaf, that the bankruptcy is old information, and the borrower now has his or her finances well under control. Naturally, it's vital that no new late payments appear on your credit report. A consumer wants to distance him or herself from the bankruptcy. To convince lenders that your financial picture has changed since the bankruptcy, you have to show a new, clean credit history. Even one new report of a late payment may cause lenders to believe the potential borrower is still suffering financial difficulties. From a creditor's perspective, there are some advantages to lending to someone who has recently filed bankruptcy. The fact that the bankruptcy has discharged old pre-existing debts makes it easier for many borrowers to repay new debts. Out from under the obligation to repay the old debt, these borrowers are also now free from the threat of potential judgments, wage garnishments, or other collection efforts that might limit the borrower's available funds to repay the new debts. In addition, federal law prohibits debtors who have had debts discharged by a previous bankruptcy from having new debts discharged for as long as 8 years after the original bankruptcy filing. So, a lender can be assured that any borrower who has recently discharged debts in bankruptcy won't be able to discharge any new loan for years. Rebuild credit with a secured loan. It's always safer for a lender to make a loan that is secured by some form of property rather than an unsecured loan. After all, if the borrower should default, the lender can recover the amount they lent from the security property, whether it's a car, home, or funds on deposit in a bank account. The safety of having a backup source for repayment makes lenders more likely to offer secured loans to consumers reestablishing credit after a bankruptcy. Expect to pay more, but not for long. Offering the bank collateral may get you a loan, but it won't get you a low interest rate, at least initially. Immediately after a bankruptcy, you should expect to pay a higher interest rate on just about any kind of loan. Steve Rode, president of MyVesta.org, says families with a good credit history pay an average of $1,100 each month for mortgage and auto loans. But due to higher interest rates, after a bankruptcy, a family pays almost $1,900 for the same items. That's an increase of about $800 a month. But the high interest rates don't have to last forever. Once a consumer has started to reestablish their post-bankruptcy credit, he or she can refinance their loans at lower rates, and it can happen pretty quickly. Chance Nelson, an Indianapolis man who applied for and got a car loan just a few months after bankruptcy discharged his debts, said his first vehicle out of bankruptcy had an interest rate of 21%. After paying this for about 2 years, he went and traded it in and purchased another at 13.99%. Through a series of refinances, within 5 years of filing bankruptcy, the interest rate on Nelson's auto loan was down to just 6%. Of course, if you plan to refinance any loan, be sure it doesn't have a prepayment penalty. As your credit rating improves and lower interest rates become available to you, refinancing becomes an increasingly attractive option. Subprime merchandise cards at www.csbcards.com. One type of loan that's available to virtually all post-bankruptcy borrowers is a subprime merchandise card. This is a credit card that's easy to obtain but can only be used for online merchandise. It's not a Visa or MasterCard, but reports to the credit bureau like one. This allows you to add new positive credit on your report quickly, since virtually everyone is approved. A subprime merchandise card works by reporting $5,000 in credit on your report and thereby increasing your high credit limit while at the same time lowering your debt-to-credit ratio. The end result is a significant improvement in your overall credit profile. Again, while it's not a Visa or MasterCard, it does give you the credit benefits of one. In spite of these limitations, for a post-bankruptcy borrower who needs to establish new credit, a subprime merchandise card is the best option. Many of these cards can be found at the website www.csbcards.com. Bankruptcy is serious, but it doesn't last forever. The decision to file for bankruptcy is very serious and has far-reaching consequences. It should never be entered into lightly. If you're thinking about filing bankruptcy, discuss your legal rights with an attorney. Credit ratings can plummet as a result of a bankruptcy filing. It usually takes some planning, patience, and the willingness to pay high interest rates for a while to reestablish a good credit rating. To rebuild good credit, you'll have to maintain a history of timely payments, get a couple new loans, and avoid overusing your new lines of credit. But since lenders focus primarily on the last 12 to 24 months of a borrower's credit history, it doesn't have to take long to restore your credit and have access to loans at conventional interest rates. Currently, subprime merchandise cards seem to be the credit-challenged consumer's secret weapon. To find out more about them, just visit the website www.csbcards.com. This video has been brought to you by CreditSecretsBible.com, the fastest way to raise your credit score, guaranteed. For more information, please visit creditsecretsbible.com.